72 hours. That is how long you have before the silver market makes a move that will determine the next 6 months. Not a guess, not a prediction, a deadline. Because in the last 48 hours, 3 things changed that have never happened simultaneously in the modern silver market. And when you see what changed, when you understand the timeline, you will realize this weekend is not just another weekend. This is the inflection point. Let me show you exactly what happened and why the next 72 hours matter more than the last 72 days. Thursday afternoon, January 29th, 2026, 4:47 p.m. Eastern. COMEX released emergency variance data showing registered silver inventory dropped 4.1 million ounces in 24 hours. That is the largest single-day withdrawal in COMEX history. Not the largest this year, not the largest this cycle, the largest ever recorded. 4.1 million ounces pulled out of vaults in one day. Total available inventory now sits at 14.3 million ounces. That number should terrify you, and I'm going to show you why in a moment. Friday morning, January 30th, 8:15 a.m. Eastern, the CFTC filed an emergency session notice for Sunday, February 1st to review position concentration limits in precious metals. Emergency session, Sunday. That means whatever they are addressing cannot wait until Monday's regular business hours. The filing cited extraordinary market conditions and concentrated position risk. Translation: somebody is holding too much silver and the CFTC is panicking about what happens when they move. Friday afternoon, January 30th, 3:00 p.m. Eastern, China's State Council announced Lunar New Year factory closures will extend an additional week beyond the normal schedule, citing energy grid maintenance. That pushes reopening from February 17th to February 24th. Why does that matter? Because China refines 65 to 70% of global silver. An extra week of closure means an extra week of zero refined silver supply hitting global markets. And that week, February 17th to 24th, overlaps exactly with COMEX March contract expiration, when 22.7 million ounces are expected to stand for delivery. 3 events, 48 hours, and they create a perfect storm that detonates in exactly 72 hours. Here is the timeline. Sunday, February 1st, CFTC emergency session results announced. Monday, February 2nd, February silver contracts expire and March contracts become front month. Tuesday, February 3rd, first delivery demands for March contracts must be posted. By Wednesday, February 4th, we will know if COMEX can actually deliver or if they are going to default. That is 72 hours from right now. And everything that happens in silver for the next 6 months gets determined in that 72-hour window. Now let me show you why these 3 events are not random, why they are converging now, and why the people who understand what is happening are positioning this weekend while you are watching this video. Start with the inventory number, 14.3 million ounces available. That is total COMEX registered inventory as of Friday close. Sounds like a lot until you see it in context. October 2025, COMEX had 42 million ounces available. November, 35 million. December, 24 million. January 15th, 18.4 million. January 30th, 14.3 million. The depletion is accelerating. 4 months ago, there was 3 times more silver available than today, and the rate of withdrawal is increasing, not slowing. But here's the critical piece most people miss. That 14.3 million ounces has to cover 2 months of delivery obligations simultaneously. February contracts, 11.8 million ounces, still need to be delivered this week. March contracts, 22.7 million ounces are expected to stand for delivery. Total obligations, 34.5 million ounces. Available inventory, 14.3 million ounces. The math does not work. COMEX is short 20.2 million ounces. They cannot deliver what has been promised. Something has to break. Now, in a normal market, this is where dealers would step in and provide supply, but this is not a normal market. Here is what makes this different. The 4.1 million ounce withdrawal Thursday, that came from one entity, one vault, one withdrawal notice, one account. And based on the vault location identifier in the filing, that withdrawal came from JPMorgan's facility. JPMorgan just pulled 4.1 million ounces out of deliverable inventory in one day. Why? Either they are taking physical possession for themselves, or they are moving it out of COMEX's reach so COMEX cannot use it to meet delivery obligations. Either way, they are reducing available supply right as delivery crunch is hitting. Think about the timing. February contracts expire Monday. Delivery obligations are maximum. Vault inventory is minimum. And the largest holder of physical silver in the world just pulled another 4.1 million ounces out of the system 72 hours before expiration. That is not coincidence, that is strategy. JPMorgan sees what is coming and they are positioning. They are removing supply from COMEX deliberately, so COMEX becomes even more dependent on JPMorgan for future deliveries. When you are the only supplier during a shortage, you set the price. JPMorgan is manufacturing the shortage so they can charge whatever they want in March. Now layer in the CFTC emergency session, Sunday. The filing did not name specific entities, but it referenced concentrated position risk and extraordinary market conditions. Translation: someone is holding a position so large that if they liquidate or if they demand delivery, it breaks the market. Who could that be? Well, we know from December 28th CFTC filings that JPMorgan disclosed 750 million ounces of physical silver. That is 52 times larger than all of COMEX's available inventory. If JPMorgan wanted to, they could demand delivery on every open contract, and COMEX could not fill even 3% of it. That is concentrated position risk. So the CFTC is meeting Sunday night, 36 hours from now, to figure out what to do about this. The options are limited. Option 1, force JPMorgan to reduce their position. Good luck with that. They own physical metal. There is no legal mechanism to force someone to sell physical assets they own outright. Option 2, change COMEX rules to limit delivery demands per entity. That protects COMEX, but it destroys confidence in the exchange. If you cannot take delivery when you want, what is the point of the contract? Option 3, emergency halt on silver trading while they figure it out. That triggers panic and probably crashes paper silver prices while physical premiums explode. None of those options are good. Every choice the CFTC has this weekend creates some kind of market disruption, and they have to choose something because doing nothing means COMEX defaults on delivery obligations starting Wednesday. The CFTC is trapped. JPMorgan has them cornered, and the decision they make Sunday night will determine whether silver rallies or crashes Monday morning. That is why this weekend matters. You have 48 hours to position before the CFTC announces their decision and before Monday's market open reacts. Now add the third factor, China's extended closure. Normal year's Lunar New Year shutdown is February 10th through February 16th. This year they just extended it through February 24th. That is 14 days of zero Chinese refining instead of 7 days. Why does this crush COMEX? Because COMEX does not mine silver. They do not refine silver. They are just a warehouse and a ledger. The physical silver in their vaults came from somewhere. Most of it came from China eventually because China refines 65 to 70% of global supply. When Chinese refineries shut down for 2 weeks, new, refined silver stops flowing into the global system. COMEX cannot restock their vaults from Chinese supply. They are stuck with whatever inventory they have right now, 14.3 million ounces, to cover 34.5 million ounces of obligations over the next 60 days, and they cannot get more from China until February 24th at the earliest. Even if Chinese refineries restart on schedule, it takes another 10 to 14 days for refined silver to be shipped, cleared through customs, assayed, and deposited into COMEX vaults. That means new Chinese supply will not reach COMEX until mid-March, but March delivery obligations are due starting February 3rd. The timeline does not work. COMEX is operating on existing inventory with no resupply for 6 weeks. And that inventory, 14.3 million ounces, is already insufficient for current obligations. This is a supply crisis with a hard deadline, and the deadline is 72 hours away. So those are the three factors. Inventory depletion accelerating with the largest single-day withdrawal in history on Thursday. CFTC emergency session Sunday to address concentrated position risk. China supply offline for 2 extra weeks during peak delivery season. Individually, each one creates stress. Together, they create a crisis that peaks this weekend and resolves one way or another by Wednesday. Now let me show you what the smart money did Friday because their actions tell you they see this coming. SLV, the largest silver ETF, $410 million in outflows Friday. That is institutional money exiting paper silver exposure. Why exit now? Because they see the delivery crisis forming and they do not want to be holding paper when COMEX potentially defaults or when the CFTC changes the rules. Better to get out Friday and reassess Monday after the emergency session results are announced. COMEX Silver Futures Volume Friday, 340% above normal. Open interest in March contracts jumped 14,000 contracts in the last 2 hours of trading. That is 70 million ounces of new paper claims created Friday afternoon. Why the rush? Because traders are positioning for volatility. They expect Monday to gap up or gap down significantly based on Sunday's CFTC decision. High volume Friday means institutions are placing bets before the weekend knowing something big is coming. Physical silver dealers. Friday evening, premiums jumped from 22% to 31% in 4 hours. Dealers are not raising premiums for fun. They are raising them because they know they cannot get inventory. COMEX is tight, China is closed, dealer wholesalers cannot source metal, so they raise premiums to ration the inventory they have left. When premiums spike going into a weekend, that tells you the people closest to physical supply see a shortage coming. Options market Friday, silver call volume 11 times normal levels. Calls are bets that prices go up. Traders bought massive upside calls for February and March expiration. Why? Because they expect Monday to gap up. They expect the CFTC decision or the delivery crisis to spike prices, and they want cheap call options bought Friday to pay off Monday. That is not retail activity. That is institutional positioning before a known catalyst. Every indicator Friday afternoon, the outflows, the futures volume, the premiums, the options, all of it points the same direction. The people with the best information expect significant volatility Monday based on events this weekend. They positioned Friday. You have this weekend to decide if you agree and what you do about it. Let me walk you through the two scenarios that could unfold and what each means for your silver position. Scenario 1, CFTC caves to JPMorgan. Sunday night, they announce new position limits or delivery restrictions, but they exempt physical holders or they create carve-outs that do not actually affect JPMorgan. Markets interpret this as COMEX acknowledging they cannot force JPMorgan to do anything. Confidence in paper silver drops. Monday morning, paper silver gaps down 8 to 12% on the open as traders sell contracts they do not trust. Physical premiums expand to 40 to 50% as everyone tries to exit paper and get metal. If you own paper, you lose immediately. If you own physical, you ignore the paper price drop because your metal is worth 40% more than paper suggests. Scenario 2, CFTC goes nuclear. Sunday night, they announce emergency trading halts, forced position liquidation, or contract cash settlement at predetermined prices to prevent COMEX default. This is the extreme option. Markets interpret this as COMEX admitting they cannot deliver. Monday morning, paper silver crashes 25 to 35% as contracts get cash settled. Physical silver spikes 60 to 80% as the paper and physical markets completely disconnect. COMEX loses all credibility. Physical becomes the only real silver market. If you own paper, you get cash settled at crash prices and you miss the physical spike. If you own physical, you just made 60 to 80% in one day, but you have liquidity challenges because dealers cannot source inventory to buy from you at scale. Both scenarios, paper loses and physical wins. The only difference is the magnitude. Scenario 1, paper loses 8 to 12%, physical gains 40 to 50% in premium value. Scenario 2, paper loses 25 to 35%, physical gains 60 to 80%. Neither scenario is good for paper holders. Both scenarios reward physical holders. The CFTC decision Sunday determines which scenario we get, but the direction is the same either way. Now here is what most people are not considering. There's a third scenario. The CFTC punts. Sunday night, they announce they need more time to review. They delay the decision. Markets open Monday with no clarity. In that scenario, chaos. Nobody knows what the rules are. Nobody knows if COMEX will deliver. Traders sell first and ask questions later. Paper silver drops 15% on uncertainty. Physical premiums spike 50% on fear. By Tuesday or Wednesday, when the CFTC finally decides something, the damage is already done. Paper holders sold at the bottom. Physical holders are holding elevated premium metal. Indecision is almost as bad as the worst-case scenario for paper, and it is great for physical. So out of 3 possible scenarios, 2 are catastrophic for paper, and 1 is just bad for paper. All 3 are positive for physical. The risk-reward is completely one-sided. If you own paper going into this weekend, you are taking massive downside risk for unclear upside. If you own physical, you have minimal downside and significant upside in 2 out of 3 scenarios. The math says physical is the right position before Sunday night. Let me address the counter-argument because some people will say this is fear-mongering. Nothing will happen. COMEX has survived stress before. This is just noise. Okay, let us examine that. COMEX has survived stress before. True, but COMEX has never faced this combination of factors simultaneously. They have never had inventory this low, obligations this high, and a single entity controlling this much physical supply all at the same time during a period when the largest refining source is offline. This is not normal stress. This is structural breakdown. The largest single-day withdrawal in history happened Thursday. That is not noise. That is unprecedented. The CFTC does not call emergency Sunday sessions for noise. They do that when something is breaking and they need to act before markets open Monday. China does not extend Lunar New Year closure by a week for no reason. They do that when they need to conserve energy or when they see internal demand requiring them to keep refined silver domestic instead of exporting. Every single signal is red. Dismissing this as noise is not skepticism. It is denial. Here is what I am watching this weekend and what you should watch. Saturday evening, COMEX updates vault data for Friday's activity. If registered inventory dropped below 13 million ounces, Scenario 2 probability spikes. If it held above 14 million, Scenario 1 is more likely. Sunday morning check physical dealer premiums. If they are expanding beyond 35%, dealers are panicking. If they are holding at 25 to 30%, supply is tight but manageable. Sunday evening, 6 p.m. Eastern, CME Globex opens for metals trading. Watch where March silver futures open. If they gap up or down more than 4%, markets are pricing in significant Monday action based on CFTC expectations. Sunday evening, 8 p.m. to 11:30 p.m., monitor for CFTC announcement. They might release results Sunday night. They might wait until Monday pre-market. Either way, the decision will be public before markets open. Read it carefully. Look for words like emergency measures, temporary restrictions, position limits, forced liquidation, cash settlement. Any of those terms means scenario 2. If the announcement is vague or delayed, that is scenario 3. If it is mild adjustments that exempt physical holders, that is scenario 1. Monday morning, 9:30 a.m., markets open. The first 15 minutes will tell you everything. If paper silver gaps down hard and physical premiums are spiking, the bifurcation is happening. Exit paper immediately if you have not already. If paper silver gaps up and premiums are stable, the market interpreted the CFTC decision as bullish or neutral. Hold and reassess. If trading is halted or delayed, that is scenario 2 playing out. Expect chaos and prepare for physical premiums to explode once trading resumes. By 10 a.m. Monday, you will know which scenario we are in. Your decisions need to be made this weekend, not Monday morning. Because once the scenario is clear, it is too late to reposition. The people who moved Friday are already positioned. The people who move this weekend will be positioned before Monday's open. The people who wait until Monday to react will be reacting to price moves that already happened. You cannot win by being late. Here is what I am doing this weekend. I own physical silver, coins and bars, no paper exposure. I am holding regardless of Monday's move. If scenario 2 unfolds and physical premiums spike to 70%, I am not selling into the chaos. I will wait for markets to stabilize and for legitimate price discovery to occur. If scenario 1 unfolds and premiums expand to 40%, I might consider taking some profits on a portion of my position, but I am holding the majority long-term because the fundamental supply shortage is not resolved by one CFTC decision. I have cash available. If scenario 1 plays out and paper silver drops 10% Monday while physical premiums are at 40%, that is an arbitrage opportunity. Buy paper at $90, take delivery, sell physical at $126. The spread is the profit. But that only works if dealers can source inventory and if delivery actually happens. High risk but high reward if it executes. I am not recommending you do this. I am telling you what I am considering so you have a framework to think through your own decisions. I am watching all the indicators I mentioned Saturday and Sunday. I am not making assumptions. I am following the data. If the data says scenario 2, I adjust my expectations even though my position does not change. If the data says scenario 1, same thing. The position is set. The weekend is about information gathering and scenario planning, not about changing positions last minute. Let me give you the 72-hour action plan based on what you own right now. If you own physical silver, do nothing this weekend except monitor information. Your position is correct for all 3 scenarios. Relax. Sunday night and Monday morning, pay attention to price action but do not panic sell into volatility. Physical premiums will tell you the real value of your metal, not paper prices. Wait at least 48 hours after Monday's open before making any selling decisions. Let the dust settle. If you own paper silver through ETFs, futures, or allocated storage, you have a decision to make this weekend. Do you trust the system to deliver? Do you believe COMEX will honor contracts? Do you think the CFTC will protect your interests? If the answer to any of those is no, you need to exit paper before Monday. Sell Friday's close if you have not already, or sell Monday pre-market if you can. Do not wait for the open. Pre-market allows you to react to news before the crowd. If you are stuck waiting for regular market hours, place limit orders to sell on any gap up or place stop losses to sell on any gap down below your risk threshold. If you are thinking about buying silver this week and physical is the only thing that makes sense given the scenarios, do not buy paper going into this uncertainty. If you buy physical, expect to pay 25 to 35% premiums. That is current market. Do not wait for premiums to drop. If scenario 2 happens, premiums will double, not drop. If you want exposure before Monday, pay today's premium and take possession. If you own silver mining stocks, you are in a hybrid position. Stocks are equity, not metal. They will react to paper prices Monday more than physical premiums. If paper crashes, stocks will drop even if fundamentals are positive. If you want to hold through volatility, that is a calculated risk. If you want to protect capital, consider selling Monday pre-market and reassessing after the CFTC decision is digested. Stocks can always be bought back. You cannot buy back lost capital. 72 hours from now, we will know if COMEX survived or if the paper silver market broke. We will know if the CFTC protected the exchange or protected investors. We will know if physical and paper silver are still connected or if they have bifurcated permanently. The next 72 hours will determine the next 6 months of silver price action. The people who position correctly this weekend will profit. The people who ignore the warning will learn the hard way. This is not fear-mongering, this is data. The largest single-day withdrawal in COMEX history happened Thursday. The CFTC called an emergency session for Sunday. China extended refinery closures through peak delivery season. These are facts, not speculation. The scenarios I laid out are logical conclusions based on those facts. The action plan I gave you is rational positioning based on those scenarios. You do not have to agree, but you do have to decide, because Monday morning at 9:30 a.m. Eastern, the decision will be made for you by the market. If this video helped you understand what changed and why the next 72 hours matter, share it. Send it to someone who owns silver, someone who needs to know what is coming this weekend. Most people are not paying attention. You are. Now help someone else pay attention. Subscribe to this channel. Monday morning I will post an update breaking down what the CFTC decided, how markets reacted, and what it means going forward. And drop a comment below. Tell me if you are holding physical, holding paper, or converting this weekend. The clock is running. Stay sharp.